Okay. Yeah. Hello, everyone. Welcome to day 2 of this very important ACCA P2P session, Practice to Pass. Before I proceed, uh, I need a quick confirmation. Can people hear my voice? You can confirm me using the chat box that is available. Okay, that's great. So you can see the screen. You can even hear me clearly, and my video is also clear to all of you, right? Okay, that's great. So I hope the first day went well for you people. What do you think? Was first day interesting? And the topics that I covered relating to budgets and especially the way to write theory. So what do you think? Was the first day good for you people? Okay, great. So those who missed out the first day, I think there is not an issue. You people can watch the recordings. The recordings are very much available now. So you can easily watch the recordings, okay? Uh, please call Hamza. Okay, so let's begin with the proceedings for day 2 of this important session. Before I start, simple house rules I need to repeat. If you want to uh, interact with me, you can use this chat box that is available, and you can just write whenever I ask you question using the chat box. Other than that, if you are not part of my WhatsApp groups, the global performance management groups, where you can interact with your fellow members. So this is my WhatsApp number. You can just note down the number. If you're not still part of the group, admin is also with me. Admin, can you share the group link for those who are new to this session? So you will get the link, but still, if you cannot join through the link, no issues. This is my number. You can quickly send me a quick WhatsApp message after the session today. At the end of the session, I will share the group link with you people so that you are able to join the WhatsApp group for further updates and for further new developments as well. Okay. So I think that's okay. Please quickly confirm, is everything okay at your end? Because I seeing some issues. Is the sound clear? Okay, great. Now, so the day-wise plan, according to the plan, today is the day for variances, then day 3 for decision making, day 4 for performance measurement, and day 5 advanced costing technique. A quick recap of the plan, the 2-week plan. You have to watch all the 5 days of the webinar. That is very compulsory. The $1 million plan for day 1 was shared on the WhatsApp group. There were certain links that I shared with you people, and those links were basically the one through which you gonna cover the things. Okay, whatever video links I've shared with you people, you covered those. If you do cover those along with the current webinar, you will have a very good coverage of your syllabus. So the mindset behind that $1 million plan is that you cover all those videos along with the current webinar. You will be very much prepared for the paper. Okay. Grand revision to be announced soon. I'll share the details in the WhatsApp group. I will share the index for the chapters that you have to read. and the slides are already available to you through the email. Mock, yeah, it's very important. I will remind you every day because mock is very important. So if you are interested in the paid mock based sessions, so do let me know to the WhatsApp group. Today's agenda is pretty much simple. Today, as once again, I did ask students through the WhatsApp group what topics you want me to cover today. So majority was in favor of planning and operational, and as well as sales mix and quantity. So according to your own wish, I have made a plan that I'll be covering. Learning curves is important. I will give a recap of learning curve to start with because learning curve is very much connected to planning and operational variances. So that's why I will start with learning curves because in my planning and operational, learning curves will play a major role. Uh, so then we'll move towards planning and operational variances, then sales mix and quantity, and it's all practice, practice, and practice day to day. So today we'll be doing lots of questions. So stay tuned, stay with me. At the last 10 minutes, we'll have a general question and answer session. So the simple rule is if you want to ask a question relating to that particular slide or the topic that I'm teaching, you can write in the chat box. And for all the other generalized questions, you hold your questions till the last 10 minutes. Okay. Yeah, it's very important to tell you the breaks because yesterday people were asking me about the breaks. So there are two breaks after every hour. 5-minute break will be there. Right. Happy? Okay. Now, learning curves. A quick recap, okay? Because the rest all I'll solve through the question. Basically, the concept of learning curve is that when the labor performs the job for the first time, okay, because the labor doesn't have the experience and the knowledge, so the time that the labor takes is the highest time, okay? It's the highest time, but due to repetition of the same work, the labor gets more experience and knowledge, and because of that, the time reduces because of more learning, and the labor is able to perform the task much earlier. So the time goes down, and eventually a time comes where the learning process stops, where the labor becomes complete expert, and there is no reduction in time thereafter. Okay. So normally there are two techniques to basically work out the figures in case of learning curve. Though I would say two techniques through which you can work out the most important thing, that is y, which is cumulative average time. So one is the double approach and one is the log approach. In my $1 million plan today, I have shared the detailed link of the videos where I've covered learning curves in previous webinars from scratch. So if you're still confused, you can watch those videos. But other than that, it's very simple. Both the approaches are useful. Both the approaches will give you the same answer. But the more popular one is the log approach, which is this formula. But let me tell you one thing. When there is one type of a question in which you have to work out the learning rate, okay? When learning rate is not given in the question and you have to work out the learning rate, so I recommend everybody, if you have to work out the learning rate, then in that case you use this double approach, okay? Then in that case you use double approach. Otherwise, in normal situation, you use log approach, okay? So let's see how things move on today. I'll try to cover up both, but let's see how things are done today. So yeah, for the detailed videos, I have mentioned that I did share today in the $1 million plan. You can just watch the videos from those previous links. But today I'll cover up certain things in which you will definitely see the learning curve will be used. So generally, we have to use log approach. But remember, when you are not given with the learning rate. There are certain OTs where you have to find out the learning rate. So in that case, it's best to use double approach. Okay, so you can see the formula double approach like this. That's okay. A quick one. There are certain limitations of learning curve as well. To just to cover up the theory, learning curve is applicable only in labor intensive environment. So any organization that uses machine, so learning curve will not be applicable there. Okay. Second, it is useful in stable conditions. So this is also a limitation because the more stability is there, which means repetition will be there, and stability, repetition will be there. So more repetition, the more chance the labor has to learn new, the more chance labor has to get new knowledge and experience. And like this, the time goes down. Okay. So if the conditions are stable, it's good for learning curve because more stability means more chance to learn due to repetition. But if it is not the case, if conditions are not stable, in that case, yeah, a learning curve will not be useful. It is again very important to keep in the mind that if work is of repetitive nature, then only you can use learning curve because repetition is important. Plus, labor turnover should be low as well, which means that if less people are leaving the organization, this means the more chance they have to learn. And the more chance they have to learn, this means that there will be more learning curve applicability. But if people are leaving the organization, if the labor turnover is high, so yeah, in that case, no chance to learn much. So these works as limitations. If these conditions are not present, then learning curve will not be useful. This is very important to keep in the mind, the budgets that are affected by learning curve. Okay, so here I'll take a short, I'll not discuss right now. I'll just move towards the question, and through the question I'll cover this point. So I'll just leave this right now, and once I will move towards the question, so I'll come back to this and will explain budgets affected while solving the question accordingly. Okay, so just hold this for a few minutes, and let's move on now towards the next area, which is known as planning and operational variances. Please just give me a few seconds. Now, before I start with the variances, the core area, I would want to share the analysis with you people again, and this analysis definitely will help you a lot. As you can see here, from December 2007, these are the questions that have been tested for variances. So you can see December 7, June 8, June 9, December 9, June 10, December 10, December 11, December 12, and more than June 13, December 13, June 14, December 14, June 15, December 15. Now you can see how frequently this topic is tested in the paper. So June 16, you can see June 17, 18, until July 2020. So tested a lot, and a quick analysis will actually tell us that 18 times up till now, till July 2020, it has been tested. And if you look at the breakup, topic wise breakup, so general variances, which means variances that relates to F2 that used to come very early, not these days, 11% of the times. And then mix and yield has been tested 28%, sales mix and quantity 17%, and the most tested is planning and operational. Okay, so that's why it's the pick of the day. That's why many of you requested me as well to go with planning and operational. So that's why I selected planning and operational for today's session. Along with that, I've also selected mix and yield, just because in the previous webinar of March 21, I did cover mix and yield. So I'll share the $1 million plan for that. So you can cover that through previous session. And many of you requested me for sales mix and quantity. So that's why I'm starting with planning and operational, and then I'll move towards sales mix and quantity as per the requirement of all the audience that they shared with me through the WhatsApp groups. Okay, so and yeah, it's a right choice. I would say planning and operational has been tested a lot in the examination, so that makes a lot more sense to cover planning and operational in webinar. And my plan is to make this really easy for you people. Okay, now what I'll do is I will definitely be using spreadsheet as well today. I will solve certain questions on spreadsheet so that I give you the idea how to handle spreadsheet in examination for variances. And yes, it's truly speaking really easy in paper to use spreadsheet for variances. In fact, I would say you all are blessed to have spreadsheet in your examination, because spreadsheet can make your life pretty much easier, especially when it comes to variances. Okay, so I'll show you that how will I do this. Okay, so let's begin with planning and operational variance. Now, before I start, I just need to give a quick background, because I always believe that background is important. Many of you exactly don't know what is the basic concept behind planning and operational. So I will just take few minutes, not too much, to just give you the basic idea about what the thought process should be for planning and operational variances. You know the names of the variances that you learned in paper management accounting, like material price variance, like material usage variance, labor rate variance, labor efficiency variance, idle time variance, sales price variance, and sales volume variance. I'm sure you pretty much know what are the basics behind these variances. Like if I say material price variance basically deals with the difference in the standard price and the actual price that you paid, right? Same goes for sales volume variance. Basically tells you the difference between the planned volume and the actual volume that you were able to sell in the market, right? So it's all okay, the basic F2 variances, and I'll start from that only, so as to give the idea to what the mechanism is. So just listen to me very carefully here. Listen, at the start of the year, when this the new year is about to begin, at the start of the year, there is a planning team. There are certain people who basically are part of the planning, and these are the people who basically make standards. These are the people who basically establish the standards. So at the start of the year, the planning team does what? They just set up the standards, and they share all the standards, whether it's for material, whether it's for labor, whether it's for sales, and they share all these things with the what you say with the operational team. Okay, so it's a very important word. I'm saying operational team. Okay, now operational team means what? Team that basically is involved in the operations of an organization. So this operational team basically comprises of mainly your purchase manager is part of this operational team. Then you have a production manager, part of this operational team, and then you have your sales manager. So these are the people that are basically part of your operations, right? So the planning team, the team that actually is preparing the standards, basically prepare the standards at the start of the year, and they communicate these standards to the operational team. Okay, now what is the task of the operational team? So operational team, it's very important for them to ensure that they remain within the standards. Okay, so they have to make sure that they remain within the standards, and at the end of the year, you get the actual results, right? So they try their best to remain within the standards, and at the end of the year, they get the actual results. Now, what we do, we simply compare. So how do we calculate variance? The question is, how do we calculate variance? Okay, so we simply compare the standard and the actual, right? The standard and the actual. So we just compare the standard made at the start of the year, and we compare that with the actual results. So we get a difference, and that difference is known as variance, right? So it's a normal F2 concept. It's a normal management accounting concept that you work out the variance, which is basically the difference between the standard and the actual, right? Now, just in case, for example, you found out variances for the sales manager, basically that results in sales price and volume. For production manager, material price and material usage variance, and like this. Sorry, for purchase manager, material price, and for production manager, material usage and labor efficiency, and all these, right? So for example, if you are one of the managers, maybe you are a purchase manager or a production or a sales manager, and your variance basically is adverse variance. And remember, you are getting bonuses on the base of variances. Okay, on the basis of variances, you get the bonus, which means your performance is actually being assessed on the basis of variances, right? So if your variance is favorable, you get a bonus. If your variance is adverse, you will not get a bonus. Now, just in case if your variance came out to be adverse, right? This means you are in a position to lose the bonus. That's a fact, right? You will lose the bonus. So you're very disappointed and you don't know what to do, and you're very confused, and you're asking yourself where I went wrong, what I did wrong. I worked really hard and blah 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 blah. Now, the variance is adverse, and you just think and tell me, later on, it was found that once the variance is there, okay, it's adverse variance, and you were very much, upset, and you ask the planning team, or you ask certain people, come on, just let's investigate why this came out to be adverse, okay? And you all started the investigation, and you found out that the reason for this variance getting adverse is that the standard that was made at the start of the year, there was some error in the standard. The standard was not correct. The standard was a bit wrong standard. Okay. So now, yes, it was proved that the standard was not appropriate. The standard was not correct, and there was a flaw in the standard. Now, I'm asking you people, I need a quick answer from you people. If you are the operational manager there, maybe you are a purchase manager or a production manager or a sales manager, you tell me, do you want your performance to be assessed on this adverse variance, which actually came out because of the wrong standard? Come on, let me quickly look at your responses. So your responses clearly shows that no, you will never want to be assessed on the basis of wrong standards, which means you will never want to be assessed on the basis of that standard which is not appropriate, because that will not show your real performance, right? So that's okay. So that is why what we're gonna do is the answer of adverse variance that you have, what we'll do, we'll break that variance into planning and operational variance, which means we'll break that variance into planning and operational variance, which means the planning variance basically will be the variance that resulted because of the planning error that was done by the planning team. Okay, so what you do, the original variance that you have here, now this is the original variance you have, right? So what you do, from this original variance, you take out the component of that variance that came because of the planning error. Okay, so if you just take out the component of the planning error variance, so you will definitely be left with the variance that came because of the operational performance, and that is known as operational variance, because this variance genuinely resulted because of the efforts of the operational team. So this basically indicates the real genuine performance of the operational team, which is your purchase manager, production manager, and your sales manager. Okay. And yes, if you are at this place, so definitely you all will agree with me that now you'll be very much happy that your performance should be assessed on this operational variance only and not on this planning variance. Okay, so you don't want your performance to be assessed on planning variance, because you would say this is something outside my control, and to assess my real performance I should be assessed on the basis of operational variance. Okay, so this is the history behind the invention of planning and operational variances. This is the logic, this is the concept through which we basically bifurcate the original variances into two components of planning and operational variance. Okay, so I hope, my friends, this history, a quick background that I just gave you people, is pretty much clear and will set the right mindset for you people for planning and operational. So what is your quick feedback? Is it interesting and clear to all of you? A quick response will be really nice right now. Okay, thank you very much for your quick response. Thank you. So yeah, so now it's clear that yes, this is the logic behind just breaking this planning and operational into two parts, and every operational manager will want to be assessed on the basis of operational variance and not on the basis of planning, because planning is something which is outside their control, right? Great. Now, for that, we have a certain list of formulas here. Now, basically, this topic is tested for material variances, for labor variances, and for sales variances. So you can see here, material price variance, the normal material price variance that you work out using the normal F2 or management accounting formulas. What you do, you break this into planning price and operational price. Exactly the similar concept that I discussed here will now be applicable with all the variances. Okay, so the concept that I just developed in front of you people, so for every variance you will break that into planning and operational, but only in that case where there is a planning error, which means if the planning error exists in price, okay, material price, so you will bifurcate that into price planning and price operational. Same goes for if the error is existed in quantity, that is kg, if standard of kg is not appropriate, so you will bifurcate that usage into planning usage and operational usage, right? So it's very simple idea. Okay, then similar mistake is very much possible. It's very much possible in case of labor as well. Okay, so in case of labor, if we see here, if the mistake is in setting the rate, if the wrong rate has been established by the planning team at the start of the year. So what you're going to do is that you will break the rate variance into planning rate variance and second into operational rate variance, right? And same, if there has been a mistake in the hours, standard hours that labor should take, okay? So in that case also, you will bifurcate the labor efficiency variance into planning efficiency and operational efficiency variance. Okay, so I'll just stop here for a while, and I'll just stop here for a while and we'll come towards sales later on. Uh, the basic idea is pretty much clear to all of you, right? Now, material is basically a cost based, one, okay, and labor is also basically a cost-based one. So remember, material is a cost-based one, labor is a cost-based one. These both are cost-based. Whereas sales, on the other hand, it's not a cost-based, it's a income-based variance, right? So one thing is pretty much clear, that these two are cost-based, and the other, that is sales, is basically revenue-based variances. So there might be a slight difference in these two. Okay. Anyways, now, now what I'm gonna do is, before I move towards my first question, because I will be using a lot of question today to make it more easy for you people. So yeah, just a short glitch. There is some technical issue. Just wait, please. Okay. So yeah. So now, before I start with the question, I just want to make it very simple for you people, so that you do understand the technique, the $1 million technique that I just want to tell you people right now. See, for cost variances, that is material. Material is a cost variance, right? And for labor, labor is also a cost variance. So for cost variances, I'm telling you a very good, quick shortcut. And through this shortcut, you can easily work out planning and operational variances. So just first, very calmly listen what I'm doing. Maybe you don't understand initially, but once I will solve a question, that will automatically be very much clear to you people. Okay. So first of all, let me just quickly tell you, uh, starting from this planning and operational area. If I start with first, let's suppose labor rate, operational. Okay, operational. Now, operational is what? You know that managers, as I just made the background initially, that managers are willing that their performance should be assessed on the basis of operational variances and not on the basis of planning variances, right? So remember, whenever you are calculating the operational variances, it's basically very simple. Revised is compared with actual. Okay, so revised standard rate minus actual rate into actual hours. So basically what I said is that this is basically R versus A. So operational variance that you work out, whether that is for material or whether that is for labor, is basically what? Come on, it's what you need to learn. It's R versus A. It's revised standard versus actual standard. Okay, it's revised standard versus actual standard, and this is basically R versus A. Are you getting the point? So R versus A is revised versus actual. Okay, you can even check this for labor efficiency operational as well. So this is your labor efficiency, and you can see here it's revised standard hours allowed minus actual hours. Okay, I do assume at this point that you actually know the basic formulas of the variances, right? The basic F2 management accounting formulas I'm talking about. So I'm sure you know that those ones. So that's why I'm directly telling you the shortcut, the mnemonics to use here. So you can see here it's revised versus actual. It's R versus A. That's fine. Now the similar thing will be for material as well, because both are cost based. Now coming towards the planning one. So please just listen, stay calm, okay? Stay calm and listen what I'm doing here. Now coming towards planning. So for planning, what you are supposed to do. In planning, basically, you are comparing two standards. One, that was the original one that the planning team established earlier. And second is the revised one, which means the standard that should have been, okay? So what you do, you compare the two standards together. That is, you're comparing a standard, which is the original one, O, okay, and the revised one, which is R. So I would say this is O versus R, right? O versus R. So when it comes to planning variances, it's a comparison between original versus revised. Original versus revised. Okay. And when it comes to planning efficiency variance, so again, it's the same thing. It's the original standard hours allowed minus revised standard hours allowed. So it's O versus R. So you can quickly look here, things that I'm highlighting here in front of you. It's basically giving you a very good shortcut. And the shortcut is, whenever you are calculating planning variances for cost, let me write here, planning variances for cost. So the mnemonic or the shortcut is O versus R. Original versus revised. Original standard versus revised standard. It's a fight between the two standards. It's a fight between the two standards. Okay, can you keep this in your mind? And when it comes to operational variance, okay, when it comes to operational variance, so basically it's a fight between revised and actual. Okay, it's a fight between revised and actual. Are you getting my point? So it's R versus A, revised standard versus actual results. Okay. And I've already made this very much clear that operational team real performance will only be assessed on the basis of operational variances. Is my sound clear to all of you? Can people hear me? Okay, that's good. Okay. So guys, let's sum up what we have covered up till now. Operational team performance should only be assessed on operational variances. Operational variances for cost are worked out using a very simple shortcut, revised standard versus actual results. Planning variances basically are the one that arise because of the planning error done by the planning team, which means the operational team is not responsible for that. Agreed? Which means in case of that, the planning variance will be worked out from a difference between original standard and revised standard. Okay, done? Perfect. So let's keep this here and let's not move towards the next area. And I think it's time to switch to the past paper question first. Now today's session I have planned very thoughtfully. So my request is I'll be trying my best to go for maximum questions today, but I really don't like one approach of certain students is that they if they see a question that they already know, they just leave the session. Okay, they just leave the session. That's wrong. Listen, it's the technique that you have to learn. It's not the question, it's the technique that I want to tell you. And maybe you know one question that I'm doing right now, and maybe the next one would be a different one. So please stay connected. These 3 hours are really important for your success. Everything is important. Don't take anything lightly, because if you take anything lightly, I think you are doing a big mistake, okay, with your own self. Anyways, I'm starting with a question, a very good popular question, Bokko, which is of June 2015, and I will quickly read certain important information here and will jump towards the question. So my basic focus is on these two questions first. And let's see what it says. It says, what is labor efficiency planning variance after taking account of learning effect? Now, this is what I want to tell you people, that learning curve with planning operational is very much likely to be tested in the paper. Okay. Second, it says, what is the labor efficiency operational variance after taking into account learning effect? So it's basically very much obvious, that there could be a mistake that the planning team can actually make. Okay. Okay, now for overhead variances, my friend, not applicable. Okay, overhead variances are not tested in F5 very much. In fact, I would say very, 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 very less chance of overhead variances. So don't be afraid of that. Okay, I'll switch to the previous slide. Fahad, just wait. I'll just switch once I'm just done with this quick reading. Now, the question that you can see in front of you is a question where it's learning curve with planning and operational variances. Okay, it's just the start, right? So just hold on, just be patient. If you've even done this question, please just hold on. I'll be moving towards different difficult questions today. And like this, the coverage will be excellent today when it comes to planning operational and as well as the sales mix and quantity. So let's see what further we have here. Okay, now I'll read certain important things that are given to me in this question. Bock company is manufacturing company. Let's highlight it. It has a small permanent workforce. Okay. It has a small permanent workforce, but it is also reliant on temporary workers, whom it hires on 3-month contract whenever production requirement increase. All buying of the material is the responsibility of the company's purchasing department. Okay. And the company's policy is to hold low levels of raw materials in order to minimize inventory holding cost. Budgeting is done on spreadsheets, and a detailed variance reports are produced each month for sales, material cost, and labor cost. Departmental managers are then paid on a monthly bonus depending on the performance of their department, right? Bokko is operating in a fast changing environment, and its finance manager thinks that the original standard costs are unrealistic. Now, original standard costs are unrealistic. He is considering revising the budget by analyzing existing variances into planning and operational element, which would help to improve performance. Okay. 1 month ago, Bokko began production of a new product. The standard cost, now this is important, okay, just note down. The standard cost for one unit was drawn up to include the cost of 84. Okay, so the cost for one unit is 84, which is based on 7 hours of labor at 12 per hour. So it's very simple. I would say that this is my original cost card. Now remember everybody, whenever you are solving a section C question or a section B question of planning and operational, listen what I'm saying. Listen what I'm saying. The $1,000,000 technique is, just note it down please somewhere. The $1,000,000 technique is, whenever you are solving a section A question or a section B question, the $1,000,000 technique is that you find out while reading, you find out the original cost card first, and that is 7 hours into 12 per hour makes 84. Okay, so you figure out the original cost card and as well as figure out the revised cost card. Two things you have to figure out: the original cost card and the revised cost card. Just note it down. This is my best tip to you people. Whenever you are solving planning and operational questions, just note it down. You quickly figure out two things: the original cost card and the revised cost card. Are you getting the point? Okay, so this is the original one. That's fine. Now let's move on. Actual output of the product during first month of production was 460 units. So this is your actual units, right? 460 are your actual units. And the actual time taken to manufacture the product totaled 1860 hours. Okay, so this is the actual time at a cost of 26,040. So for 840, sorry, I beg your pardon, for 460 units, the actual hours are 1860. That's fine. Now, please just find out the planning error. This is the crucial thing. The $1,000,000 point is you need to find out the planning error. Okay, and you all know the operational manager, whether it's production, whether it's your sales manager, or whether it's your purchase manager, the operational team will not accept planning error. Okay, so wherever you find the planning error, remember, just revise the standard. Okay, and what is a planning error? It's a good question. What exactly is a planning error? Planning error basically means error that arises due to any factor which is not in the control of the operational team. Okay, so planning error is any error which basically arises due to a factor which is not under the control of the operational team. Okay, so whenever you are reading the scenario, try to find out, listen, try to find out anything which is not in your control, anything which is not in the control of the production manager. So if something like inflation is not in the control of the production manager or the operational team, maybe a request done by the customer is something outside the control of the operational team. Okay, wrong market planning done by the planning team is something outside the control of the operational team. So once you find out anything which is not in your control, which means you will not be held responsible for that, and for that particular thing which is outside the control of the operational team, let me repeat it, anything which is outside the control of the operational team, for that you need to revise the standard. Okay, you need to revise the standard, right? So let's find out anything that happened here. After being presented with some initial variance calculations, the original variances, the production manager has realized that the standard time per unit of 7 hours was the time taken to produce the first unit. Okay, and a learning rate of 90 should have been anticipated for the first 1000 units of production. Okay, now what do you think? The time that they took was for the first unit, and this is the time that they took every time, right? But they failed to incorporate what? The learning curve. They failed to incorporate the learning curve. right? The production manager has consequently been criticized by other departmental managers who have said that he has no idea of all problem this, the failure to anticipate learning curve has caused. Now, what do you think? What do you think? If you are not considering the learning curve impact, your standard will be the right one or will not be the right one? Come on, can you reply me quickly? The standard will be right or wrong? And what do you think? It is important to revise the standard now? If the standard is wrong, so you cannot assess the real performance. And if you cannot assess the real performance, you need to revise the standard. Okay? So you need to revise the standard for sure. Agreed? So yes, revision should be made for the standard. Revision should be made for the standard. Agreed, guys? Yeah. So I need to revise the standard. Okay? That's fine. Bock company uses cost plus pricing to set selling prices for its product. Once initial cost card has been drawn up, prices are then reviewed on a quarterly basis. Now I need to revise the standard because the standard that we just saw is not incorporating the learning curve impact, which means I need to now work out the revised standard. So now what I'm going to do is, remember, I have here the units. So units are 460, okay? And the actual time for 460 units is 1860 hours. So my calculation for the revised standard should be based on 460 units. Okay, it should be based on actual 460 units. Is that clear to everybody? So yeah, it should be based on 460 actual units. So what I'm going to do is I'm going to apply the log formula here, the log formula that I just showed you earlier. This is the log formula. Yeah, this one. Y is equals to ax to the power b. So I'll be using this log formula to work out this. So let me just do it in front of you here. Yeah. Now it's very simple. I need to work out the time for 460 actual units, right? So the cumulative units formula is y is equals to ax. A is what? A is what? A is basically the time for the first unit. Okay, so the first unit time is how much? Let me quickly check. Question. It's 7 hours, right? It's 7 hours. Okay, so 7 hours is the time for the first unit. That is A. Multiply this with X. What is X? The number of units for which you need to work out the time. So cumulative number of units for you to work out the time is 460. As you can see in the question, the units are 460. Okay. Power. Okay. Power B. What is B? I'm sure you know. It's log learning rate. And what is the learning rate? So the learning rate is 90% divided by log 2. Okay. Now, I need a quick answer from you people. If you can quickly jump into this working, and can you, any one of you, tell me what is the answer you are getting for cumulative average time for 460 units? Yeah, 460 units. What answer are you getting here? Yes, please. The per unit answer I'm talking about. Okay. Now, it's very important in question like OTs to do make sure that you look at the decimal policies. Right now, the question hasn't stated in examination. I expect proper decimal policies to be given. Yeah, one thing more here. We were given with the B value here, which is basically log 0.9 divided by log 2. So whenever you are given with the value, so it's better to use that value rather than to work out the value yourself. So what I'll do here, I'll just use the value that is given to me here rather than calculating the value. So it's basically negative 0.152, if I'm not wrong, right? So what is the answer of average are you getting? So people have mentioned here, it's 2.756. Now, to be on safe side, I would say at least take 3 decimal places for cumulative average. Now, this is what is Y actually? Y is basically cumulative average time per unit. It's cumulative average time per unit. Okay, so you can see here cumulative average time per unit is 2.756, and yes, it's per unit. Still people are confused what it means, so I'll tell you. It means that the per unit time for 460 units, the average per unit, let me repeat this again, for 460 units, for 460 units, per unit average, not for 460 total here. Okay, the per unit average is 2.756. So you can take this to 4 decimal places per unit average, or you can take this to 3 decimal places, but I would say at least 3 decimal is important. 4 would be fine as well. At least 3 decimal places to get the right answer. So 4 is also a very good option here. Okay, so I can see certain discrepancies here. I don't know why people work out a different answer if they can see my workings. So it's 2.75 6, or I would take to 4 decimal places. I can see certain options of 4 decimal as well. And this is where people are doing wrong. They don't know the exact rounding off policy. They don't know how to round off the things. So let me take here based on your workings. I can see majority have given me the answer of 2.756.4. Okay, so it's 6.4 I've taken. Now this is the average time per unit. So how to calculate the total time for 460 units? It's very simple. Let's multiply this with 460 units, and I will get the total time. Now, please, can any one of you tell me the total time for 460 units? It's 1268. Yeah, that's right. Okay, so 1268. Now, this is what? This is your revised standard. Yeah, it's standard because, this was your original standard. And you converted this into the revised standard by applying the learning curve impact. Okay, so now the average is 2.7564 rather than 7 hours. So this is revised standard hours allowed for you for actual units. Okay, so this is 1268. I'm sure this is clear to all of you. This is 1268 hours, as you can see in front of you. 1268 hours is the revised hours allowed considering the learning curve impact. Okay, if you missed out, so don't worry. You can watch the recordings later on. Okay, Rukaiya, just try to understand the concept. Revise hours allowed, right? So if you're working out revised hours allowed, you know what is standard hours allowed? Standard hours allowed is basically standard hours into actual units. Okay, so if you're working out revised hours allowed, so again, that would be revised standard into actual units. So that's why I'm taking actual units here. Okay, Rukaiya? Okay, now let's not fight in for small decimal issues right now. Okay, let's not fight. Let's move on. It's 1268. That's fine. Okay, so don't be worried about it. The only thing I need to tell you for learning curve is at least take 3 decimal places, or 4 decimal place is a good option. So 4 decimal place for cumulative average time calculation only, right? So 4 decimal place is important. So that's it. 1268 hours done. Now I have the revised hours allowed of 1268 hours, and now I am here. So let's find out the answer. Now the original standard was for per unit, which is 7 hours into 12 per hour, right? So let's do the working. And what I'll do is and I've also worked out the revised hours. So that is 1268. So just remember revised hours of 1268, and I want to jump towards the formulas now. Okay. Now here I am. What I told you is, remember operational and planning. So we are working efficiency, planning, and operational. Okay. This is what we are doing the calculations here. So you can see the formulas are pretty much clear. Standard rate per hour, original standard hours allowed minus revised standard hours allowed. Here you can see standard rate per hour, revised standard hours allowed minus actual hours, right? So if I solve through my shortcut. So if I start with labor operational here, so I know one thing. If you don't want to remember the formulas, you know one thing. It's revised versus actual. Okay. And planning is what? Original versus revised. Right? So let's move on. Now remember, the entire calculation is being done for 460 units. Okay. These are your actual units. 460 units. So the actual hours, how much were the actual hours for 460 units? It was very clearly given in the question. If I can quickly tell you again, yeah, it's 1860. See, 1860. Fine. Okay. 1860. How much is the revised hours? 1268. We just work out using the learning of impact, right? Into the standard rate per hour, which is 12. Okay. And here you have the answer. So revised hours allowed minus actual hours into standard rate will give you the answer. And can anyone of you confirm me what is the answer? Yes, please. It's 7140. Okay. 7140, and this 7104. And is it favorable or adverse? So it's adverse because actual is more than the revised standard. Actual is more than the revised standard. Okay, so actual is more than the revised standard. I think that's okay, and there is no issue in this as well. Getting the point, everybody? Okay, so 7104, answer of this is how much? It's C, right? It's C. A means adverse here. Adverse. Okay. Now for planning, O versus R. Okay. Revised is 1268. Rate per hour remains at 12, and I need original. So how do I work out original hours allowed? As per the formula, I need original hours allowed, right? Original standard hours allowed. This is what I need here. Okay. Revised, I already know. So what to do here for original? 7 hours multiplied by actual units are how much? 460. I'm sure you know this, that whenever you take anything as revised hours allowed or original hours allowed, the units are actual always, right? So 7 hours into 460 is what is the answer? 460 into 7. Okay. So I hope this is clear. This is 3220. 3220 minus 1268 into 12, and the answer is how much? Can anyone tell me the answer, please? Okay, so it's 23,424 D. And is it favorable or adverse? Now this is important. Normally students do get confused when it comes to planning and operational sorry, people do get confused when it comes to planning variances, favorable and adverse. Okay, so let me tell you. Listen, if I give you the option that whether you trust revised standard or the original standard, so what will be your answer? You trust revised or original standard? So I'm sure your answer will be that we trust revised standard because revised is more realistic, right? Oh, how can you trust original? It's wrong. Okay, you trust revised standard because revised is more realistic. So if you trust revised standard and if it is more realistic, so according to revised standard, the hours should be 1268 and original says the hours should be 13220. So if you trust revised standard because revised is realistic, so revised standard hours are less and less hours mean less cost and less cost means it's a favorable variance. Less hours, less cost, favorable, right? So the answer is a favorable variance. So whenever you are judging favorable adverse from planning variance perspective, just listen to these keywords. And what are those keywords? The keywords are, just think whether you think revise is more realistic than original. So your answer would be always revise is more realistic. And if revise is more realistic, that's okay. If revise is more realistic, so just look here. If revised hours are less than the original, so it's good for the business as the cost will be less. And if cost is less, it's favorable. Okay. So this is how we judge always favorable and adverse for planning variance. So I hope this is clear to all of you and this is clear. Okay. So see, this is working for you. O versus R versus A. And this remains same for material as well as labor, and your answers are clear. So you can see here O versus R versus A. Getting the point, everyone? Clear? Okay. Difference between IVA rate variance is a one that deals with the rate per hour of the labor. That is you can see here this 12. This is rate. Okay. And efficiency variance relates to the hours, how quickly you should have produced the product. So I can say rate variance will say difference between the actual rate that you paid and the standard rate, and efficiency variance basically deals with how many hours you should take compared to how many hours you did take. Okay, great. So I think this is clear. Guys, what's your feedback up till now? Things going good? Yes or no? Yeah, 460 were produced during the learning curve period. Yes, Mikkel. I'll try to do that, Fahad. Okay, great. So let's take a break as I did tell you initially, I will be taking a 5-minute break. So it's 9:41 here. Uh, and we have a break till 9:45. So let's take a quick break and see you after the break. Don't go. It's very important till the end of the session. Okay, so welcome back, students. I hope you all can hear my voice clearly. Yes, a quick confirmation, everyone. Is this okay? Okay, great. Okay, let me take a few questions. Arvind, yeah. Revise is more reliable than original. Obviously, revise is the better standard. Okay, that's why you went for revise, right? Okay, now the next question is if learning rate is not given, how to find out? So today I'll try my best, Abdul Wahid, to cover this as well. Okay, how to solve log on a regular calculator? For that, I need to explain you later on. You can just WhatsApp me and I'll tell you, I'll make a video for you and we'll share the video on the WhatsApp. Okay. Okay, you need to look at the slide of material. Don't worry, Rukaiya. I'll share the slides with you people, so you'll get the slide for material as well. Okay, I'll explain question number 5 right now. Yeah, actual. Now, obviously, now what is actual? You know what is actual? Actual is, I can't say actual is better than revised. What my point here is, if I compare the two standards, standard versus standard, so which standard is better? It's revised. And in case of actual, you need to judge if it's a cost variance. So if actual cost is less than the revised cost, so it's good. Okay. So in terms of comparison with actual, it's the normal mindset that we have. But when comparing planning variances or finding out favorable and adverse for planning, so in that situation, you look at the standards. It's revised standard or original standard, which is the better one. So it's a common sense that revise is a better standard. That's why you went for revise. Okay. Okay. 7 hours were given in the question. I can quickly show you from where I found out 7 hours. Yeah, it's here. 7. Fine. Okay, Fahad, I will try to cover up interrelationship between variances. Just wait, because there are so many things. So let me just focus on one area and just wait, just be patient. Just see what all I'll cover today, okay? Okay. Again, irrelevant questions coming up. I did mention earlier, just ask questions relating to the slide right now and just hold on for all the other questions till the end of the session. Anyways, now that's done. That's okay. Now, question number 5 is very important that I did want to solve here. So just listen to me very carefully. Uh, Planning and operation is not finished yet. What I'm doing, you'll get to know till the end of the session how I planned the today's session. So it's a smart planning that I've done. Now, question 5. Which one of the following statements about production managers' failure to anticipate learning effect is true? Okay, it's a very good OT. So just listen carefully. Which one of the following about production managers' failure to anticipate learning effect is true? Number 1, there will be no unnecessary extra labor cost. Second, the selling price of the company's product would have been set too low. Adverse material price variance would have arisen. The sales manager's bonus would have still be guaranteed in spite of production manager's failure to anticipate the learning effect. Now, what you have to figure out here is to figure out that out of the 4 statement, which statement is correct, okay, and correct in terms of what? That if production manager didn't anticipate the learning curve, so because failure to anticipate learning curve was there, which of the one thing that will result out of the 4 statements? Okay, so now first of all, there will be no unnecessary extra labor cost. Is it true or false? So this is false. Why? Because failure to anticipate learning curve will result in extra labor cost. You know why? Because if you are not anticipating learning curve, which means as the labor starts production, so time gradually goes down, down, and down, which means labor will be able to produce more number of units than what was planned, because labor is not taking 7 hours as it took for the first unit. The second unit will take less hours than 7. The third will take much less hours. And because less hours are being taken to produce the units, this means more units will be produced by the labor, resulting in more labor cost. Okay, so it says no unnecessary extra labor cost will arise. That's false, because unnecessary labor cost will arise, right? So that's wrong. Second, the selling price of the company's product would have been set too low is wrong, because the selling price will not be too low. Selling price would be too high. You know why? As you can see here, they are using cost plus pricing, if I'm not wrong. See, they are using cost plus pricing, which means they work out the cost and on the basis of that they set the price. So if you do not incorporate learning curve, which means you are pricing the product based on 7 hours, and in actual the labor is not taking 7 hours. It's less than 7 hours every time the labor is producing the units, because of the learning curve impact, right? So 7 hours is the standard that you just used, and based on 7 hours you worked out your what you say your cost and your selling price. So based on 7 hours, as the hours are high, the cost will be high, the price will be high. So it's wrong to say that the price would be low. Great, done. Okay, I'll jump to D first. The sales manager's bonus would still be guaranteed in spite of production manager's failure to anticipate the learning curve. Okay, now would you think that that would be the case? No, that's wrong as well. That's wrong as well, because if production manager fail to anticipate the what you say fail to anticipate the learning curve, which means as the time reduced every time the labor was producing the units, so labor was producing by taking less time, and like this more units were produced. And if more units were produced, which means the sales manager will not be able to sell the unplanned units. Okay, unplanned units. And if the the sales manager is not being able to sell the unplanned units, which means that sales manager will not be meeting the targets. Okay, and the bonus of sales manager would still not be guaranteed. So that's wrong, because more units will be produced than the anticipation, which means the sales manager will not be able to sell all the number of units, and in that case there is a chance that the bonus of sales manager will not be there. So that's wrong. Okay, what is the right answer? The right answer is, everybody would go for D, because they were not able to understand C. So they said, okay, D is the last option. That's wrong. D is not an option, because more units will be produced, which means the sales manager will not be able to sell all the number of units, because those were unplanned units that were produced, right? So no bonus of the sales manager. The answer is C, which for people is the least likely answer. But this is the answer, and let me tell you why. Now listen what I'll do. I'll go back to my slides and see how will I explain you this. Yeah, budgets affected by learning curve. See what I'm doing. Listen, learning curve is a very important phenomena to consider. If you ignore the impact of learning curve, then you're missing a lot of things. Lot of things, to be honest. Listen, learning curve, if you fail to incorporate the impact of learning curve, which means it will affect lot of areas. It will affect lot of budgets. For example, if I explain like this, that learning curve means what? The time of the labor will go down. Okay. If the time of the labor goes down, this means more units will be produced, which means if more units produced, so labor budget gets affected, obviously, because if labor is being able to produce more units, so labor will take in total more hours, and more hour means labor budget gets affected. Now, just listen very carefully what I'm saying. Just right now, just think, if we do consider learning curve, so what happens? Just think like this. If we do consider learning curve, so what happens? If you do consider learning curve, so it affects your labor budget, because more units will be produced by the labor, so labor budget gets affected. More hours in total and more payment. Second, overhead budget gets affected as well. How? If you are absorbing overheads on the basis of labor hours, if you're absorbing on the overheads on the basis of labor hours, which means because of learning effect, labor hours will also change. Okay, and if labor hour changes, the overhead will change. So overhead budget gets affected by that as well, because if overheads are absorbed on the basis of labor hours, so a change in labor hours will affect the overheads as well. Getting the point? Second, done. Third, production budget gets affected. Yes, failure to anticipate, sorry, not failure. It's not the right word I'm using right now. If you consider learning curve, so just imagine, as the time per unit is reducing, so labor is able to produce more number of units, and more number of unit means your production budget gets affected. Your production budget gets affected because more number of units will be produced. Okay. If more units are produced, you need more material, which means your material usage budget gets affected. There is a requirement for more material now. So material usage budgets gets affected. Okay. And if your usage gets affected, so you need to buy more material, right? And if you need to buy more material, your material purchase budget gets affected. See, such a huge impact of learning curve. So learning curve is having an impact on labor, obviously, overhead, if overheads are absorbed on the basis of labor hours. Okay. It will have an impact on production budget. Obviously, more units will be produced because the time per unit is going down. So labor can produce more number of units now within the same time. If more units will be produced, so more usage of material, usage budget gets affected. If more material is required, more you need to purchase budget gets affected. And cash budget also gets affected as well. Now, how cash budget gets affected? It's very simple. It's very simple, because labor will be paid in cash, material will be purchased by using cash. So if all these things are getting affected, which means cash budget will get affected as well. So a learning curve can have an impact on lots of budgets for an organization. Getting the point? Now listen. If you fail to anticipate learning curve, so what will happen? Now listen like this. If you fail to anticipate learning curve, this means more units will be produced. Yes, obviously, right? Because labor time is getting less and less, due to repetition. So within given hours, labor will produce more units. Now, if more units you have produced, so you need more material for that. You need more material for that, material usage. Okay. And if you need more material, so you need to purchase more material. And if you purchase more material on a sudden basis, because this was never planned, because you never considered the learning curve impact, because you ignored the learning curve impact. So you need to purchase material on a haphazard basis. You need to purchase material on an urgent basis because your labor wants to move on the production. So in that case, you will purchase the material at a higher price, and higher price means adverse material price variance. Wow, adverse material price variance. Are you getting the point? So not anticipating learning curve can have an impact on your production units, can have an impact on your usage of the material. You need more material, can have an impact on your purchase of the material, and you need to buy sudden material, and you might buy on an urgent basis at a higher price, resulting in adverse material price variance. See, huge impact of learning curve on different types of variances. Getting the point, everybody? Point D, I did mention, is not the answer because sales manager will even not be guaranteed the bonus. Okay, just because more units will be produced, so sales manager will not be able to sell more number of units suddenly and will not be able to meet the targets, and in that case will not get the bonus. So guys, is my explanation clear? Come on, a quick feedback, yes or no, so that I may move on. Understood? Was this technical or not? Happy? Come on, your feedback is, it's like a fuel for me. It's like a fuel for me to motivate myself. Okay. Rebecca, 460 units I did use just because 460 units were the actual units. Okay, so I need to work out variance on the basis of actual units. So 1000 was not relevant, 460 was important, first 460 units. Okay. Okay, I hope this is clear to all of you. And yeah, I did mention option D again and again, and I'm mentioning this for the last time. Please just listen very carefully. I'm saying that option D is not the answer because one possibility here could be that sales manager will not get the bonus. Okay, just because more units will be produced and will not be able to sell all those units, so will not be guaranteed the bonus in that case. Okay, right? Okay, yeah, Mikkel, you're right. For option B, I did explain earlier, is that selling price will not be set too low, it will be set high because you will base your selling by based on 7 hours. If you don't consider learning curve impact, so you will set your cost based on 7 hours, and 7 hour is high hours, right? Because actually your hours will go down due to learning curve. So your cost will be high based on 7 hours, which means your price will be high based on 7 hours. Okay, so clear. Umair Khalid, this is one of the possibilities because units produced will be more. This is what my point is. Okay, units produced would be more here. So if units produced would be more, this means obviously there will be a lot of inventory left, and that is the reason. Okay. Yeah, Arvind, you're right. So I hope this is clear to all of you friends. So because you didn't anticipate the learning curve impact that could result in adverse material price variance, and I did tell you the reason for that, and the reason was pretty much clear, that it's very simple, and that is you need to keep this in your mind, that price may variance may go adverse because you need to buy material urgently, and if you do that, obviously you will need to pay more for that, and this was all because you never had this in your mind that you need to purchase more material because more units were produced because of lack of learning curve anticipation. Okay. So then with this one, these three were very important one. The rest two OTs are not that much difficult. So I think you can manage the remaining two. I hope this is clear to all of you. Now we'll take up the questions at the end of the session if you have left with any questions here. So yeah, this is clear to all of you now. Now going back to the slide, and here I am. So I did mention here for material price or material usage, if you go for material price and usage planning and operational, in that case, it's simple O versus R versus A. Whether it's labor, it's simple O versus R versus A. That's fine. Okay. Now coming towards sales variances. Planning operational sales variances. Be with me everybody, because I'm jumping towards the next question now. So if I say sales variances, sales price and sales volume contribution. Now you all know that cost and sales are inverse to each other. Agreed? If cost goes up, that's adverse. Whereas if sales goes up, that's favorable. Agreed? Vice versa. If cost goes down, that's favorable. Whereas if sales goes down, that's adverse. Agreed? Right? So it's the opposite way around. So because it's the opposite way around, that's why the rule will change. And what the change will be? O versus R now will become R versus O. Make sense? Make sense? Make sense? Right? And R versus A will now become A versus R. Make sense? Make sense? Yes or no? It makes a lot of sense. It makes a lot of sense, right? So R versus O and A versus R in case of sales. Come on. Do you agree with me? Say yes or no, everybody. So yes, it makes a lot of sense. So the rules will change now because it's sales. So you can see here, revised selling price versus original selling price. For operational price, actual selling price versus revised selling price, right? For volume, revised sales units versus original sales units, right? For volume operational, actual sales units versus revised sales units. So the rules will change, and you know, because it's the opposite way around. So this is how it is. So the formulas are in front of you for sales price planning, for sales operational, for sales volume planning, for sales volume operational. Getting the point? Okay. Is this clear to all of you? I'm sure this is clear to all of you. Okay. Now, so having said that, it's now time to move towards the next question, and that is block company. And now I am moving towards a section C question where I will be using spreadsheet in front of you and will make this a piece of a cake including the theory as well. So we'll be covering theory along with calculations on a spreadsheet. Okay, so be with me. This is a good question. Now, let's start. Block operates an absorption costing system and sells three types of products: commodity 1, commodity 2, and commodity 3. Like other competitors operating in the same market, Block is struggling to maintain revenues and profits in face of economic recession, which has engulfed the country over last 2 years. So it's very simple that there is a recession here. Sales price fluctuate in the market in which Block operates. Okay. Consequently, at the beginning of each quarter, a market specialist who works on a consultancy basis for Blockco sets a budgeted sales price for each product. So there is a consultant who basically, is predicting the prices, sets the budgeted sales price for each product for the quarter, and based on his market expectations. This then becomes the standard selling price for the quarter. The sales department itself is run by company's sales manager, who negotiates the actual sales price with customers. Okay, so there is a sales manager who basically deals with the customer, and there is a consultant who sets the prices. So there are two separate people here. One is a consultant who sets the prices, and one is the sales manager who basically sells the product to the customers. And you know that operational team includes purchase manager, production manager, sales manager. The following budgeted figures are available for the quarter ended 31st May 2013. Okay. And you can see commodity 1, commodity 2, commodity 3. You have budgeted sales units, you have standard selling price per unit, and standard variable cost per unit, right? Block uses absorption costing. So again and again, the word absorption is being used. Fixed production overheads are absorbed on the basis of direct labor hours. See, as I did mention few minutes back, that you are absorbing overheads on the basis of labor hours. So in that case, I was explaining that learning curve becomes a very major factor here, because if hours of labor will change due to learning curve, so overhead absorption will also change. And budgeted costs for these for the quarter ended 31st May 2013 was this one. Okay. Commodity 1, 2, and 3 use 0.2 hours, 0.6 hours, 0.8 hours of machine time respectively. The following data shows the actual sales price volume achieved for each product by Blockco for the quarter ended 31st May 2013 and average market prices per unit. Okay. You can see commodity 1, 2, 3, actual selling price and average market prices. Okay. The following variances have already been calculated for the commodity 1 and 2. So let's see. They have already done the calculations for sales price operational for commodity 1 and 2 and sales price planning for commodity 1 and 2. So what are we supposed to do here? Calculate for commodity 3 only sales price operational and sales price planning for 4 marks. Okay, are we ready? We should be ready. So for that, let's use the ACCA platform and let's start our workings. So, okay. Part A, sales price planning variance. Second, sales price operational variance. Okay. Now, Do we remember the formula, everybody? Yeah, we do remember the formula. So what is the formula? The formula of operational variance is A versus R, actual price minus revised price, right? And for planning, the formula is R versus O, revised price minus original price, original standard price. Okay. If you want to check the formula as well, so let's quickly jump towards the formula. And here I am. Okay. So yeah, it's sales price planning, revised selling price minus original standard selling price, actual selling price minus revised selling price. So I know the shortcuts of that as well, right? So yeah, here I am. Now, let's begin with the workings. Now, what you can do on a spreadsheet, it's very important to ensure the right layout of the answer, simple calculations, simple logical layout should be used. No more complications. Secondly, the formula, the usage of the formula is extremely important. Okay. And you can perform calculation in one cell. If you can control the calculations, it's best to perform in one cell. But make sure you are using right brackets so that you are not getting the wrong answers. So let's begin. Now, I'm starting with sales price operational here. So in that case, what I'm going to do is that I will first go to the question, and I know I'll start with actual. So what is the actual for commodity 3? So actual for commodity 3 is 40.4. Okay. And the revised, and now what is the revised one? So you can see here, this is what? This is the original. Okay. And yes, this is the revised one. So this is the revised one. Okay. Just a minute, some technical glitch. Okay. Just a minute. Okay. Can people see my video clearly? Is my video clear to all of you, please? Just confirm. Is my video clear to all of you? Yeah, it's clear. The voice, sound, everything. Okay, this might be due to someone own internet issue, I think. Okay, that's fine. It's clear. Okay, thank you. Thank you for your confirmation. Okay, now my friends, so actual is 40.4. And if I say average market price, so average market price is the revised one I'm talking about is what? Yeah, it's 39.10. Okay, multiplied by actual units, right? So do we know the actual units? Yeah, we do know the actual units. That's 25,600. I'm just showing you the manual working, and we'll just do the same on a spreadsheet. Okay. Average prices are revised prices. Yeah. Right. Agreed, everybody. Okay. So now I'll just do this exact working that I did in front of you people on a spreadsheet now. So open the cell by is equals to, open the bracket. So it's 40, what it, okay, sorry. just open the bracket. It's 40.4 minus 39.1, close the bracket, right? Multiply this with the units, 25,600. Okay, can you see the workings? So the answer is, okay, the answer is 33,279. Answer is 33,279. So I have one option to round it off. So I can just round it off to complete figures. And normally we have this option here, the 10th option. See, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th option. So things get really good after this option, comma, negative if there is, and you get the answer. So it's 33,280. Now, is it favorable or adverse? So don't worry, the formula that I've shared with you people, it's quite easy to figure out. If the answer itself is positive, it's favorable. Mathematically, if the answer is positive, it's favorable. Okay. So mathematically, if the answer is positive, it's favorable. You don't have to write the formula. Okay. So if you follow my formulas, if you get the answer by default negative, it's adverse. And if mathematically you get the answer positive, it's favorable, right? So you can see it's simple. It's favorable answer. And yeah, logically also it's favorable because 40.4 is the actual price and the revised is 39.1, which means you did sell the products at a higher price. So this is the uniqueness about my formulas. Mathematically, if the answer is positive, it's favorable. Mathematically, if you use my formulas and answer is negative, it's adverse. Okay. So done with the operational. Now coming towards planning. Okay. Now for planning, it's R versus O. So revised is 39.1 minus original is, where is original? Yeah, 41.6. 41.6 into actual units of 25,600. Righto. Okay. Now, let's do this working is equals to 39.1 minus 41.6 into 25,600, and you are getting answer of 64,000. Now, by default, the answer is negative, right? Mathematically, yeah, it is. So it's adverse. Oh, I beg your pardon. It's adverse. See how easy this will become for you people. That if the answer by default is coming negative, mathematically, it's adverse. And just in case you want to ensure that your logics are okay, so okay, no issues. Rizwan Maniya has a very good answer to this as well. You trust revised or original? Come on, revised or original? So you will say we trust revise. Yeah, you trust revise. So revised price is less than the original. Revised price is less than the original. So if revised price is less than the original, my friends, which means less price, less revenue, adverse for the business, right? Less price, less revenue, because your realistic price is revised. So if your realistic price is less revenue, adverse. Okay. So mathematically, figure out the answer quickly in OTs. Logically, already mentioned here, right? So done. Marking scheme. Sir, can you tell us the marking scheme? So yeah, 2 marks for this one. 2 marks for this one. Perfect. Everything is going according to plan. Part A done. Now part B. See what Rizwan Maniya will do now. This is my smart planning for today. Now part B. So let's read out part B. Using the data provided for commodities 1, 2, and 3, calculate. Okay, what's this? Sales mix variance and sales quantity variance. Okay, now Rizwan, Maniya, you're shifting towards another topic of variances. Yes, yes, it's sales mix and quantity I'm shifting towards. So for planning and operational, I've made this very, very, very clear that if it is cost based, like material and labor, for planning it's O versus R, and for operational it's R versus A. When it comes to sales, it's the vice versa. It's the vice versa. So in that case, what you're going to do for planning, it's R versus O. And for operational, can you tell me anyone? It's A versus R. Okay. You don't have to put formulas, my friend. Come on, let's be, let's think. We are not a kid. We are not kid anymore. Why you will write formulas? Just this what I've done here. Okay. So that's okay. That's perfect. That's fine. And now it's time to work out the sales mix and quantity. So for planning operational, it's clear to all of you. Yeah, one more thing I need to just add up here that is important. And let me tell you. Listen, this what I'm telling you is something that relates to volume only. They will check the cells. Yeah, they will check the cells, and they will check your workings in the cells. That's what is examined. You need to understand, examiner says using a spreadsheet, using calculators in a spreadsheet is a big sin. No matter from which religion you belong, it's a big sin. Okay, so you can't use calculators while using spreadsheets. Anyways, as I was saying here, for volume, my friends, for volume planning and for volume operational, there are certain specific names. Volume planning is known as market size variance. Market size variance. Okay, just remember the term. This only relates to volume. And for volume operational, for volume operational, we call this market share variance. So just remember the names, okay? I just want to tell you the names here. Market size variance and market share variance are basically terms that we use for volume planning and volume operational. So my friends, we are here at a new topic, and that is sales mix and quantity variance. I really had to think about the today's plan to make this more effective, time saving, and this is how I've done it. So let's see. We are moving towards sales mix and quantity. Let me tell you, sales volume variance is broken down into sales mix and quantity. So you break sales volume into mix and quantity. So starting from sales mix and sales quantity. What is sales mix? I'll tell you. What is sales quantity? I'll tell you. But one important thing I need to tell you here is what? When do you calculate sales mix and sales quantity variance? When? So there are two conditions. If you meet these two conditions, then you are allowed to calculate mix and quantity. And the conditions are, number one, when you are selling more than one products, when you're selling more than one products, are you getting my point? When you are selling more than one products, like you sell tea, at the same time you sell green tea, so you're selling more than one products. So if you're selling more than one products, first condition met. Second, the products should be interchangeable. What? The products should be interchangeable. Okay, so what interchangeable means? For example, if you sold green tea less in the market, and you compensated that by selling more tea in the market. That happens. If the demand for green tea goes down, so this was compensated by increase in the sales of tea. So this is interchangeable, and it could be vice versa. For example, people in the market are very much health conscious. Everybody wants to diet like me. I like dieting. I'm sure you also like dieting. So if you want to diet, if you want to lose your weight, so the demand for green tea went up, and that was compensated by decrease in the demand for tea. So that is known as interchangeable. The demand for one product is going up and the demand for second is going down, or it could be vice versa. So this is interchangeable. So if the products are interchangeable and more than one products, then you break volume variance into mix and quantity variance. That's fine. So mixed variance is what? Difference between standard mix allowed and actual mix used. So these are the two key terms to remember. I'll just show you through the workings. Sales quantity variance means difference between standards units required and actual units sold. So these are the two terms: standard units required to be sold and actual units sold. Okay. So let's now demonstrate this through the calculations. But before I do, it's time for another quick short break. Let me tell you the time. It's 10:35 Pakistan time. Mute. Can you people hear my voice? Hello? Okay. 10:35 till 10:40 Pakistan time. So enjoy the break. See you after 5 minutes. Okay, welcome back. I think I'm exactly on time. Can't waste time. Okay. Now, so here we have the formulas, and I'll just read out the formula first right now, and then we'll move towards the calculation part. So sales mix variance, it's important to remember actual sales in actual mix. I'll tell you from where to figure out that. Actual sales in standard mix, okay? And after that, it's unit variance, standard profit or contribution, and then you get profit variance. Okay, so let's not waste further time and move towards the question. Part B is what I am aiming now, and let's start. First, sales mix. Now, if you're new to my sessions, if you are giving paper for the first time, this technique of mine will definitely be really easy for you for examination, and your fear of spreadsheet will finish, I'm sure. Okay, so now let's begin. The first thing is actual sales in actual mix. So let me write here actual sales in actual mix. Okay, now that's too much. Okay, second, actual sales in standard mix. Just copy. Now the word control copy is through control C. Okay, control C, control V is for paste. So do use this a lot. Now actual sales in standard mix. Standard mix. Great. Then you have units, unit variance. Okay, perfect. Then you have standard. Now, profit or contribution should I take here? That's a bit confusing, but no issues. Rizwan Maniya will resolve your issue. It's simple, my friends. Because they are using absorption costing, it's mentioned here, it's mentioned here. So in absorption costing, you go for profit volume. In marginal costing, you go for contribution. So it's profit, standard profit per unit. Yeah. Last is profit variance. Okay, a quick announcement I need to make here. Just pay your outstanding subscriptions before 25th May 2021, and don't be afraid of COVID-19. Okay, it's just a small time span. Things will get normalized in coming months, so please make sure to stay connected with ACCA. It's a global qualification. I would say a very good qualification you are doing. So make sure you do pay your outstanding subscription payments before 25th May 2021 to stay connected with ACCA. Okay. Now, then you have profit variance. Right. So, actual sales in actual mix. So there are three commodities: commodity 1, commodity 2, commodity 3. Actual sales in actual mix. Now I'll start with first actual sales, and you can see here this is where I have the information of actual sales in actual mix. So it's 29,800 first, 3,400, 25,600. This is actual sales, right? In actual mix. So let's sum up these. Is equals to sum, open the bracket, select the cells, and 85,800, right? So actual sales in actual mix you have here. Now what you need? So you need again actual sales. Oh, so the total should be same. But this total of 85,800 now should be in standard mix. You should split this in standard mix. So how to do this? That's quite easy. That's very easy. In fact, let me tell you. See, 30,000 plus 28,000 plus 26,000 is equals to how much? Can anyone tell me very quickly? Sir, it's 84. 84. Okay, it's 84. So 30,000 plus 28,000 plus 26,000 is equals to 84,000. This is your standard budgeted total expected sales. So how to work out standard mix? That's pretty much easier. For commodity 1, what is the mix? Out of 84,000, 30,000 should be commodity 1. This is standard mix. This is basically the ratio, or I would say proportion, or I can say percentage, right? Commodity 2, out of 84,000, 28,000 should be commodity 2. Okay? And out of 84,000, 26,000 should be commodity 3. So this is how we work out the standard mix percentages, which means according to our planning that out of 84, 30,000 we need to sell commodity A. Okay? And maybe if I do a quick working math here, so that gives me the idea of 30 divided by 84. So 30 divided by 84 means 35% is the mix. 35% should be, or 36% should be my commodity 1. Whereas second is 35% should be my commodity 2. And third is 31% should be my commodity 3. This is standard mix, we call it. The standard proportion that we have planned that we need to sell these products in according to that proportions. Okay. So now let's use the same proportions and let's convert the actual sales of 85,800 into this standard mix. So let's do it. See what I'm doing here is equals to bracket open 30 divided by 84 will give me that ratio, the percentage of that was 36% approximately, into 85,800 is the actual sales figure you can see at the bottom. Just write this formula. Here you have the figure. And listen what I'm going to do here. I'll copy this using Control C. We'll paste here. We'll paste here, getting the same figures. And now I will open the cell. Okay. I have this option available right at the top. And I will just make a small change. Commodity 2 quantity was 28. You can see here. Perfect. Perfect. Rizwan, Maniya, perfect. And in third case, open the cell. And the quantity is 26. Perfect. So just make it 26. Wow, that's it. Just copy this formula from here and paste it here. The figure should be 85,600, which should be obviously the same figure, and it is the same figure. So that's perfect. That's awesome. That's to the point. No issues at all, right? Right. Okay, now, so you have seen the method. Now the difference. Normal difference. If you use my formula, things are simple. The actual sales, actual mix minus actual sales in standard mix. So it's C14 minus D14. And we'll see, we are getting the negative answer, I think. Yeah, that's not an issue. Just copy this formula, just paste here with Control V. Okay. And let's apply the sum formula here as well. Oh, it's 0. Yeah. So when it's 0, it's the right working you are doing. When it's 0, it's okay. When you get 0 of sales mix, it's all good. Okay. Now, 2 figures you are getting negative and 1 figure is positive. if you use my formulas, it's quite easy to remember that if negative, it's adverse. If positive, it's favorable. If negative, it's adverse. Perfect. No issues at all. Clear? Now, I'll discuss the logics quickly after this when I'm done with the calculations. Standard profit. Okay, so where will I be able to find the profit? Now that's interesting, to be honest. I don't have profits here. What only I have is the standard selling price, okay, for 3 products, right? Okay, and I have the variable cost, right? So let's do a quick working here because I need to work out the standard profit. So that is something I need to do here. So I'll just give a reference of working one. References are important, and I can make a working area maybe here. It's my working area. 3 products, commodity 1, commodity 2, commodity 3, selling price, and it's 30, it's 35, it's 41.6, less variable cost. Okay, it's 18, first case, negative 18, right? It's 28.4, negative 28.4. Third, negative 26.4. Great, perfect. Okay. Now what is missing is fixed cost. So I need to work out fixed cost as well, because to arrive at standard profit, you need to deduct fixed cost. So from where I'm going to find fixed cost? Per unit, that too, per unit. So how is that possible? Yeah, it is possible. Okay, so how it's possible? So it's possible by working out the OAR. You need to work out OAR. Because what you have here is, let me tell you, you are given with, these are absorbed on machine hour basis. You have machine hours for each commodity, and the total budgeted cost is 174,400, right? So you need to work out OAR, because without OAR you can't do it. You need OAR. So what you need to do, you have units here, and what is the formula of OAR? So the formula of OAR is simple. Can anyone of you tell me? Budgeted overheads divided by budgeted activity levels, right? So overheads 174,400, and activity level is what you need to work out, right? So machine hours is what I need here. So let's do the calculation of this as well. Now fixed costs, open the cell, just give reference to working 2. Now this is workings that is important for you. Proper referencing is important, examiner says that. Okay, so let's work out fixed cost. Now let's work out machine hours first. So for commodity 1, commodity 2, commodity 3, 0.2 multiplied by 30,000 units. Okay. Second, 0.6 multiplied by 28,000. The interesting part is theory that is coming soon now. 0.8 multiplied by 26,000. Okay, so you can see here the total machine hours are 43,600, and let's work out fixed overhead absorption rate. So it's 174,400 divided by total machine hours, right? I think it's 174,400. Yeah, 174,400 divided by machine hours. I just need to change this figure. And the answer is 4. So it's 4 per hour. 4 per hour. Got it, everyone? It's 4 per hour. I'm sure you are getting my calculations. Yes, come on, everyone, are you with me? Say yes or no. It's simple, right? Yeah, that's fine. So it's 4 per hour. And let's now absorb. So is equals to, make sure it's a negative sign. 4 into how many hours per unit? So it's 0.2, 0.6, and 0.8. So 0.2, second, negative 4 into 0.6. Third, negative 4 into, missed out, 0.8. Okay? Clear, everybody? Right? So done with this one? Yeah, this is what I've done. Taruf, I did work out the separate overhead cost per unit for each product now. Until unless you don't work out the OAR, how can you absorb it, right? So I need to work out OAR, that I've done. Now let's apply the sum formula. Selling price minus variable minus fixed cost, 11.2. Okay. Copy, paste, 4.2. Copy, paste, 12. And you know, for the working of profit, you are getting 4 marks. Imagine 4 marks for calculating profit. The question is of 12 marks. I think it's 12 marks if I'm not wrong. Let me check. 11, sorry. So 4 marks you are getting just for calculating the profit. Agreed, everybody? Clear? Done? Perfect? Yeah, it's safe to copy paste. What's the issue? I don't see any issue in this one. Okay? Right. Now we are done with the profits. 11.2. Second was 4.2 and 12. 12. Just multiply. See? Just copy, paste, Control C, Control V, Control C, Control V. Perfect. Let's apply the sum formula. And here you are getting the answer. So if you want to make this more clear, I'll tell you a very good option. Okay, I'll tell you a very good option. This is the ACCA platform I'm using. Okay, now just select these all numbers. Just go to this 10th option and see the magic. Wow, neat and clean stuff. Neat and clean stuff. Okay, it's up to you. You can even give reference there. That's fine. You can do this as well. It doesn't matter. Yeah, it doesn't matter. Okay, so you can refer like this as well. Fine? Happy? Okay. So it's very much possible. I was just showing you. This is also this is also possible. You can do this as well. Okay. Now, clear? What did I do? Mikkel, I'm not getting. What did I do? What did I do? I did nothing. I was just saying that you can even give reference. You can even link this cell with your calculation. This is what I was telling you. Okay. Fine. Okay. Any questions, anyone? Are we clear about all the calculations? Now this Excel working I cannot share because on this ACCA platform we can't save the workings, okay? So unfortunately I cannot, but what I'll do, I can do a proper working tomorrow and will send you proper working on Microsoft Excel. Okay, so let me tell you, if you are lost in calculating profits, that's simple. I can repeat here. Selling price, simple, given in the question. Variable cost, simple, given in the question. Okay. And then you fixed cost is what you need to work out. So it was very simple. You first worked out the machine hours, right? For 3 products here. And the total of the machine hour is 43,600. Okay. And then you worked out fixed overhead absorption rate per hour. That is fixed cost divided by the total machine hours. So this will give you per hour fixed cost. And after that, you need to work out per unit fixed cost by absorbing it. So this is what you did here. Rate was 4 into the machine hours per unit. And here again, you did the same thing, right? So like this, you worked out fixed cost per unit, and then it was simple. You just had to work out the profits. Got it? So I've given you a quick recap of that as well. It's Control C and Control V. V for paste, not P. Okay? And then I worked out the answer for sales mix. So we are done with sales mix here. I hope this is clear. The answer that you are getting here is adverse. Final adverse answer. Fine. Any issues? Okay. Now, listen everybody. Okay. Now see what I'm doing. I'll just copy this stuff completely and we'll paste here. Wow. Great. And just change the name and just make this sales quantity variance. Perfect. Just change the formula according to what it should be. So let's go to our slide and see. So the formula is actual sales in standard mix. Now see, this is same. These two are exactly same. No change. So that's the best part. Standard sales in standard mix. Okay. The rest three are same. The rest three are same as this. So this is same. This is only different. The rest three are same. Wow. So let's do this. Now, actual sales in standard mix will come here, whereas standard sales in standard mix will come here. Okay? Clear, everybody? Okay, how this is adverse and favorable? Not to worry. I'll just discuss Amirta in a while, right? Fatma Durani, I think everybody can hear my voice. I think this might be due to your internet, right? Short forms are okay, no issues, no issues. Okay, so Now, as I mentioned, these two are same. So it's simple to copy paste, right? Simple to copy paste. Okay. Now, you have these figures, just copy and just paste here. Wow, perfect. Done, copy paste. And now you need standard sales and standard mix. Wow, that's so easy. Just go to the question and have a look. Sorry, I beg your pardon. Got very much excited. Sorry, this is the figure. Yeah, this is the figure. So that's 30,000. Wow, 28,000, 26,000. Here you have the answer. Interesting. Here you have the answer. Getting the point? That's it. Nothing to do further. If the answer are, now these all three are positive, right? And positive means mathematically, my formula says it's favorable. Learn the techniques, man. How easy it is becoming. Getting the point? Done. This is the power of spreadsheet. This is the uniqueness of a spreadsheet. Why are you afraid of spreadsheets? It will give you a comparative advantage in the exam. Getting the point, everybody? I hope you will be. Okay? Getting it? Come on, what's your feedback? Where are you, man? Is it interesting? Oh, you are saying me to repeat quantity variance? So easy it was. Okay, let me repeat this very quickly. Just copy these three, actual sales and standard mix, and just paste it here. Done? Okay? And standard sales and standard mix is available in the question. 30,000, 28,000, 26,000. Just right here. The rest all was well set because I just copy pasted the entire stuff from above. Because I copy pasted everything from above, my answer is clear. When company uses absorption costing, we use standard profit. When company use marginal costing, we use standard contribution. Okay, Ahmed? So I hope this is clear now. And I've repeated the calculation. This is in front of you. So yeah, done with this. Now let me tell you the marking scheme. Out of 11 marks, 4 marks for mix. Congratulations. 3 marks for quantity, 7 marks. And see how much time it took to work out quantity variance. Free, easy, 3 marks. Easy, 3 marks. This is time management. And then I already mentioned 4 marks for your profit calculation. That makes up 12 marks altogether. Are you getting the point? Okay. This is an exam question, my friend. I didn't brought this question on my own. This is an exam question. This is the level of difficulty in front of you. Okay. Great. Great. So done with this one. And one more thing I need to tell here is the own figure rule. Own figure rule means, for example, you worked out the wrong profit. Okay. You worked out the wrong profit. So your deduction of wrong profit will be done at that very point only. For example, you worked out the wrong fixed cost. This is what you've done wrong. That's it. Okay. Now, because your fixed cost is wrong, your profit is wrong. Because your profit is wrong, both the variances are wrong. But there is own figure rule. Own figure rule means that don't worry. Your deduction of fixed cost will be done once. Examiner will deduct maybe here 2 marks, maximum 2 marks. Now, because of the wrong fixed costs, your profit is wrong, no deduction will be made for that. Because of wrong profit, your variances are wrong, no deduction will be made for that. You will get complete marks for mixed variance, you will get complete marks for quantity variance. The only deduction that was done was in case of fixed cost. That's it. Okay, that's it. So that's the best part. That's the best part, and that is known as own figure rule. So deduction is made once only, and even though because of that wrong figure, other figures are getting wrong, it will not have an impact. You will get complete marks there. That is own figure rule. Right? Okay. Okay, that's great. That's because of the decimal issue. Okay, it's 6684. It's because of the decimal issue. So yeah, own figure rule clear. Now let's jump towards the next part. Now it says briefly discuss performance of the business, and in particular of sales manager for the quarter ended 31st May 2013. Okay. Okay, for 5 marks. Now Rizwan Maniya will throw another tool to make your theory strong. And I just saw someone did refer to my technique of crick. So yes, here I am. Crick. $1 million technique. Calculate the variance that I've done already. Think about the reason that you have covered from your books, from the notes. Okay. Think and select. Select means it should be according to the scenario. It should be according to the case study. Okay? Case study. Then interdependence. What is interdependence? Interdependence means one reason making one variance favorable and other adverse. Now, what is interdependence? A quick idea I need to give you here. That is, for example, you bought lower quality material. Okay, lower quality material. So because of lower quality material, your price went down. And because your price went down, material price variance was favorable. Agreed? Low quality material means a cheaper material. Because of cheaper, price variance is favorable. That's fine. That's awesome. Okay. On the other hand, what happened? Because of this low quality, what happened? On the other hand, because of this low quality, what happened? Because of this lower quality, I would say what happened? Because of this lower quality, what happened is very simple. Try to keep this in your mind. Because of this low quality, more wastage resulted. And because of more wastage, your material usage variance came adverse. Material usage variance came adverse. Getting the point? So what is interdependence? One reason, remember my trick, remember my $1 million trick. One reason making one favorable and the other adverse. If one reason is making one favorable and the other adverse, there is interdependence between the variances. So do find this Not compulsory that this will be every time. It's not compulsory that this will exist every time. Okay? And then conclusion. Right? So, quick. Now, please, I know it's 11:15 here. According to ACCA official time, we are left with 15 minutes. But mind you, don't leave this session. I might take 5-10 minutes above. I might take 5-10 minutes above. This is for you only. I have to go home as well. It's very late here in Pakistan. But I will not leave the theoretical part. I'll make it easy for you. So be with me, okay? Else it will demotivate me a lot if you go. So you will be with me, yes or no? You're not replying. That's strange. Okay. Now, done with this one. Great. Yeah. Okay. Now, the next one. Be with me, please. So we have done the calculations, and now what I need to do here, let's make it more simple. I'll just try to make it more simple. Let's remove all these stuff and let's write things here. Okay. Now, what all I've done, calculation, I'm just writing here to sort it out. I've done the calculation for what you say, sales price, okay? Sales price, okay? Planning and operational, because I need to make theory easy for you. And for commodity 1, commodity 2, and commodity 3. So I'll just write down the figures just to make things easy to grip. Okay, so yeah, here it is. 65,560. 65,560. 56,240. 56,240. And third, we did the working, right? Yeah, 64,000. 64,000. Okay, great. And the first is favorable, then it's adverse, and third is favorable, if I'm not wrong. No, it's adverse. Okay. Now for operational, what are the figures? 35,760. Okay. 25,840. And it's adverse and favorable. And the next is 33,280. So it's 33,280, and that's what? That's favorable, right? Yeah. Okay. So certain things were given to you, and we did the working of that commodity 3 as well. So this is the first thing that we worked out. If anybody can quickly tell me the total of this planning. Anybody can tell me these two total figures. Okay, just work out and tell me. In the meantime, I'm writing the second calculation that I did was of volume. I bifurcated the volume into mix and quantity. So the mix was, it's important to control the figures, you know, in the paper. 13,366 adverse, and the quantity is 16,406 favorable. 16,406 favorable, right? So yeah, can anybody tell me the total of planning? So that's how much? Planning is 54,680. I hope this is correct. Adverse, right? Yeah. And for operational, it's 23,360 favorable. Okay. So I'm applying quick here, and the numbers are clear. Calculate the variance, and these are what I have here. Okay. Now, Remember Rizwan Maniya trick. It's simple. I'll make it really easy for you people. Okay? Now, what exactly I'm going to do is pretty much simple. Okay, one more thing. Yeah, one more thing, if you can tell me. The total of sales price, including planning and operational, is how much? Can any one of you please? Total of sales planning and operational total. It's 31,320. Okay. Adverse, right? And the total of volume as well. Can any one of you tell me volume total? Mix and quantity together, because that makes volume variance. Okay. So how much is that? 3040. Okay. That's perfect. See what I've done in here? It's completely summarized in front of you now. Just jotted down everything in front of you. So it is easy for me to handle the theory. Now, what is my strategy? Calculate the variance. We have done that. Reasons. Think and select. Now, first of all, what I'll do? First, I'll start with the first variance that I've done the calculation. And let me change the color here. Yeah. First, I'll start with sales price. Now, reason for sales price. Okay. Reason for sales price. So, what to do? How much is my sales price total? My sales price total is 31,320. Okay. Now, you tell me if you are the manager, because in the question they have mentioned that you have to assess the performance in particular of sales manager as well. Okay, so if you are the sales manager, come on, tell me, do you want me to assess your performance based on 31,320 adverse? Quick answers. Come on, yes or no? No. Why? Because this includes the component of planning error, planning variance. This is planning variance. And you know why this planning variance came? Because of the consultant issue. The question did mention that consultant is a one who is basically estimating these. So are you responsible for this? No. So listen, when you are going for reasons, so first thing is important that you can't tell the reason for this one. Reason is that this is not in your control. Planning variance is not in your control. So do mention in the question that we cannot comment on 31,320 because it includes planning variance, which is not in the control of the production or the sales manager. It's important. You have to write this. So see what I'm doing here. Start from sales price. And I'm applying quick here, okay? The total sales price to assess real performance of sales manager, we need to split this into planning and operational, obviously. So then first move towards planning and give a disclaimer. What is a disclaimer? Rizwan Maniya is giving you the mindset here. First, go for planning. Planning is 56,680 adverse. Now, what is the disclaimer? The disclaimer is that it was said by the consultant and sales manager is not responsible for this. So this is the disclaimer. The sales manager is only responsible for operational variance. Yes, every planning operational question, this is what you have to do. When you are thinking about the reasons, you do mention that. If there is a planning error, do mention in the question that the manager is not responsible for the planning part. The manager is only responsible for the operational part. This is the mindset. This is the systematic approach. These are guidelines that are helping you. I'll make this a piece of a cake for you in next 10 minutes, inshallah. Be with me. Getting the point. That's perfect. Okay. Done. Let's go back. Okay. So we can't comment on this one because this is not in our control. So what is in your control? This is in your control. So yes, can you comment on this one? Yes. Here you can comment, and here you can tell the reason if it is available in the scenario. Now, can you tell me why price variance is favorable? Now, price variance is favorable. Why? What are the reasons? Maybe you know the price variance favorable means higher price, right? So why you charge the higher price is because maybe your product is of good quality. You did a good quality product resulted in that. Cost may increase. Okay. So then operational variance is this. It appears he has performed well, achieving sales prices which on average were higher than the market price. And remember, there is an economic downturn in the market as well. Economic downturn. So disclaimer is important. And you give disclaimer for planning variances always. Agreed? Perfect. Right? So plan sales price variance done. Performance is good. No obvious reason is given in the scenario which I can say, okay, because of this more prices were charged. Okay, but I would only say the manager convinced well because manager deals with the customers. So this means he did well in selling at a good price compared to the average prices. That's fine. Now, what's next? It's volume. Listen, if there is no planning error, all the variances are called as operational variance. Just keep this in your mind. If there is no planning error, all the variances are classified as operational variances. So in case of volume, this is an awesome question, to be honest. In case of volume, there is no planning error, which means this is totally part of operational variance. Okay? Now, volume, no planning error. So this is totally operational variance. It's 3040 favorable. Now let's find out the reason why this happened. So let's break this down into two. Mix is double 13,366 adverse. Quantity is 16,000 favorable. Mix was adverse. Quantity is favorable. This means that volume is favorable because of quantity variance and not because of mix variance. Mix is adverse. Okay, so let's find out why mix is adverse. Okay, wow, such a systematic approach. See, why mix is adverse? I'll tell you why mix is adverse. So be with me. Quickly, I'll tell you this. I'll go towards my calculation to show you why mix is adverse, and like this, I'll explain you the mix variance as well. So listen, will not take much time. Now, out of the three, now what negative sign means? Negative sign means less sold. Less sold. Positive sign means more sold. Less sold. Okay? Less sold, negative. More sold, positive. Fine. Now see, out of the three, which commodity is more profitable and which is less profitable? Okay, can you tell me what's the difficult part in this? Nothing. Nothing. More profitable is commodity one. High profit, I would say. High profit. Okay. Commodity two, low profit. Commodity three, high, very high, highest profit. Now see, two commodities having high profits. See the box here. Okay. Commodity one, I'll highlight here. Commodity three, both being high profitable product, was sold less. Okay. High profitable product was sold less. Agreed? So those products that will give you high profit were sold less. Whereas low profitable product, which is commodity two, was sold more. Getting the point? So high profitable product were sold less and more profitable product were sold more. Are you getting the point? Profitable product, those were high profitable product, were sold less, which means what? Which means lesser profit, yeah, than expectation, right? And here, more profit than expectation. So yes, it's because of the change in mix that products having high profits were sold less, were compensated by selling products having low profit. That is why the sum of these three was equals to 0. The sum was equals to 0 because commodity 1 and commodity 3 was something you sold less and you compensated that by selling commodity 2 more by 1800s. So it's, exactly matching. That's why the quantity variance comes 0. That's why the unit variance comes 0. And that is the reason for mixed quantity getting 0. So commodity 1 and 3 was sold less altogether by 1800, whereas commodity 2 was sold more by 1800. And this resulted in the variance just because those on which you can earn high profits were sold in the lower quantity. Those where you earn low profits, you sold more. So overall, it's adverse because high profitable products were sold less. See, 9440 less profit, 11,486 less profit. Fine. It was compensated by 5760 more profit. But still, there is a deficit of 13,366 less profit. So going back to the slide, it's simple. High profitable product, it's adverse, right? High profitable product sold less in quantity. Low profitable product sold more in quantity. Simple reasoning. Simple reasoning. Agreed? And when it's favorable, so it's vice versa. And what's that? When high profitable product are sold more in quantity and low profitable product are sold less in quantity, so that is where you get a favorable variance. So remember, Mix variance indicates the difference between what? The actual mix that you did achieve and standard mix, what you should have achieved. So it's a mix difference, mix versus mix, right? Because the total amount of sales remains the same. It's because of the difference in mix that you got this variance. Understood, guys? Come on, say yes or no. Is the reason clear? So if this is the reason, just mention the reason in the answer. Understood, everybody? Okay. Now, you saw here actual sales and actual sales is same here. Okay. The difference is what? The difference is because of actual mix and the standard mix. Okay. So the sales figure remains the same. The difference still is because of the mix, that is high profitable sold more, less profitable sold, high profitable sold less, and less profitable sold more. Agreed? Now quantity, let's quickly discuss so that we can wrap up now. Quantity is favorable. Okay, so what is quantity variance? Try to understand. Quantity variance, you can see here the mix is same in both. It's not the mix variance because you have already dealt mix separately above. So here the mix is same, standard mix, standard mix. The mix is same in both the case. Okay, because mix variance above was the one where you just found out the mix difference. Now it's not the turn of mix. Now let's see why the difference is coming. So here the difference is because of actual sales of 85,800 compared with standard sales of 84,000. You all know if something is common in both, so the difference will not be because of that, because here it's standard mix, again here it's standard mix. So because of it's common, you will not get the difference because of the common stuff. The difference only comes because of the uncommon thing. Getting the point? So this is uncommon, right? Actual sales 85,600, standard sales was 84,000, which means actually you sold more quantity compared to the planned quantity of 84,000. Your planned quantity units were 84,000. In totality, you had to sell 84,000, but in actual, you sold 85,800. So it's the quantity difference. Here, there is no involvement of mix. Okay, so your quantity is more compared to your planned quantity, and here you can see all the three commodities are favorable, which means for all the three, more units were sold. That's why more units sold means it's favorable for the business. Okay, great. So to sum up then, mix variance reflects the mix difference, okay, where the total sales quantity remains the same. That is actual. Got it? Quantity variance is the one where mix remains the same, whereas the difference is because of the total sales quantity. Agreed? Great. Now let's go back to the reasons. Favorable of quantity could be due to maybe decrease in price. Yeah, price went down, quantity went up. Successful marketing, yeah, resulted in higher quantity. Good quality product, yeah, resulted in higher quantity. So you need to search these reasons in the scenario. If there are given, do mention. That is why we say think and select. So this is what you have to think, and you have to select according to the case study. If there are any indications given, then only. Okay. If it is adverse, so what's the meaning? Adverse could be because of vice versa. Increase in price, unsuccessful marketing, poor quality product may result in decrease in the quantity variance. Think and select. Find out from the scenario which suits here and then write only. Okay, so done. Covered this as well. Now let's go back to my slides and see what I am supposed to write here. So now guys, it's turn after price, it's turn to move towards volume. Okay, reasons. Correct, I'm applying here. Split this into mix and quantity. Okay, so the mix is 13,366 adverse and quantity is 16,406 favorable. Still I'm at this second point of reasons. First I gave you the reasons for price and now I'm giving you reasons for volume. Okay, okay, now the total volume is 3040. Great, done. Now why sales mix is adverse? Reason, due to what? Increased sales related to lower margin commodity 2, low profit, right? Low profit, with sales of commodity 1 and commodity 3 actually being lower than the budget. So this is the reason. Low profitable products sold more and high profitable products sold less. Agreed? Reason. That's it. Okay. Now what about this being favorable? To be honest, no reason is given in the scenario. You can skim later on as well. You won't find any reason like decrease in price. It's not decrease in price because price variance is also favorable. Okay, so make sure it's clear in your mind. Price variance operational was favorable. Operation was favorable. So no reason as such like decrease in price. Maybe like what you say, good quality product. No indications given. So overall, it's favorable. Then it's good. That's fine. Done. Reasons done. Then comes interdependence. I don't see any interdependence in this question. What is interdependence? One reason making one favorable and adverse. So I don't see any interdependences here. Okay. So if there is no, leave it. Leave it. Okay. And now conclude. So let's conclude here. So see now, the last part of the conclusion. See everyone. It's very simple to figure out. Now, what do you think? How should we conclude here? How should we conclude here? So conclusion is simple. This is sales price and this is sales volume, right? Listen everybody. If I add these two together, if someone can add these two together and tell me sales price and sales volume, because the question has stated to discuss the performance of the business, okay, and sales manager in particular. So if I just add sales price and volume together, what is the total? Can any one of you tell me? Remember, one is adverse and one is favorable, okay? One is adverse and one is favorable. It's wrong figure. So the total of these two is 28 to 80. Adverse. 28 to 80. Please just hold on for 2 minutes more. 28 to 80. Yeah. Price and volume. Price and volume. If you just add these two together, so it's adverse. So this means overall sales performance is bad. Okay. Overall sales performance is bad. Right? Agreed? So overall sales performance is bad. But you know why this happened? Because of huge planning mistake. Because of huge planning mistake done by the consultant, which was of 54,680. Because of the huge planning mistake done by the consultant. That's why it's It's adverse. So can your performance be judged on this figure? If you're the sales manager, say yes or no. Can I conclude your performance on this figure? Say yes or no. No, no. So remember my last wordings. Whenever you need to judge the performance of the operational manager, it should always be done on the basis of operational variances. I repeat, whenever you need to judge the performance of the operational managers like sales, purchase, production, you always need to do on the basis of operational variances. Okay, so let's ignore this now and see the performance. Let's ignore this now and see the performance of the sales manager. Now, for that, what I need to do, I'll tell you. Let's change the color. For that, what I need to do, I'll use this figure and I'll use these three things. Are these under the control? Yes. Are these under the control? Yes. Now you tell me, what is the total sum? Operational price favorable, adjusted with adverse mix, adjusted with 1604 favorable quantity. These all are operational ones, okay? Because there was no planning error in volume. Now, can you net off these all for sales? Can you net off these all for sales? So what is the sum? The sum of these all is what? Tell me, everybody. It's favorable by 26,400. 26,400. So, see, a big difference. You can't judge the performance of the manager on this. You have to judge on the basis of operational variances. And volume is operational here because there is no planning error. Understood, everybody? Are you with me? So the conclusion part coming up. Conclusion part coming up. And what's that? The total variance is this. This looks poor, but it is due to inaccuracy of sales forecast made by the consultant. Okay. However, sales manager performance is quite satisfactory as the overall variance is 26,000 favorable. So this is operational only. So remember, you always have to judge the performance on the basis of operational variance. This is your conclusion. This is the end of CRIC as well. I hope the way I've controlled the scenario was awesome. So let me recap the last thing. When you're judging the performance, you're writing the performance, remember CRIC. First, calculate the variances or use that are given in the scenario, then come towards reasons. For planning ones, you are not responsible, so just mention that we are not responsible for these, and then come to operational ones and then tell the reasons why that happened. Find interdependence if there is any, and then you give conclusion, and conclusion will only be given on the basis of operational, okay, only be given on the basis of operational variances. Are we clear? Everybody say yes or no. Is CRIC clear to all of you? Is this clear to all of you? Come on, what's your feedback, man? I've worked so hard today. Happy, everybody, with the calculation techniques, with the theory techniques? Come on, say yes or no. Great. So done with this stuff. I'll share everything on the WhatsApp group. For material mix, I'll share the $1,000,000 plan along with learning curve calculation as well. So please be part of the WhatsApp group. If you are still not part of the group, make sure you are part of the group. So for that, please just send me a quick WhatsApp message at this number and I'll add you in the WhatsApp group for further details. I'm really sorry I took your time today more, but now before the end of the session, give me your feedback. How was the today's session? How was the today's session overall? Planning operational sales mix quantity. The way I covered the things. How was the today's session of variances? Like the techniques, like the methods, spreadsheet usage, way of writing the theory. Yes, please. What's your feedback? Are you happy? Is F5 becoming easier or not? Okay, so thank you very much for your feedback. Do give ACCA Pakistan feedback right after the session. Once the session gets ended, you will get a feedback form. Make sure you do give feedback to ACCA Pakistan, which is very important as to how the session is helping you overall. Okay, so please do give the feedback. Remain active in the group. Remain active in the group, and see you tomorrow. Until then, take care. Have a nice day. Bye.